US investors might have to sell off whopping $800 billion in Chinese equities if financial ties between the US and China break. US institutional investors currently possess Chinese ADRs worth $250 billion, their Hong Kong stock holdings worth $522 billion, and 0.5% of China's A shares, totaling over $800 billion in Chinese equities. US investors could exit A shares within 1 day, while requiring 119 days for Hong Kong stocks and 97 days for ADRs. If so, Chinese investors might need to sell US financial assets worth $1.7 trillion, comprising $370 billion in equities and $1.3 trillion in bonds. So, could India be the winner amid the conflict of world's two biggest economies? The escalating US-China trade war, marked by Trump's imposition of up to 245% tariffs on Chinese imports, has created significant global disruption and a potential opportunity for India. As the US targets China's tech, minerals, and consumer goods sectors, India's minimal trade exposure, just 2.7% of US imports, shields it from direct impact, allowing it to emerge as a neutral and scalable manufacturing alternative. While Beijing has responded with retaliatory duties and tighter export controls, India has maintained a non-retaliatory, conciliatory stance, seeking closer trade engagement with the US instead. This strategic posture, combined with India's $26 billion in manufacturing incentives under the Make in India campaign, is drawing renewed global interest. Apple has significantly expanded its India operations, a 60% increase over the previous year. India now assembles all iPhone models, including premium variants, with its share of global iPhone production poised to hit 30%. Amid these shifts, Chinese firms are also reassessing their India strategies. Facing mounting tariffs and reduced access to the US market, Chinese companies have shown increased willingness to comply with Indian regulations. They are now open to minority ownership in joint ventures and technology-sharing agreements they previously resisted. Despite the momentum, India's structural challenges remain. Manufacturing accounts for less than 13% of its economy, and industries still depend heavily on Chinese inputs and foreign machinery. Businesses also face hurdles such as a shortage of skilled labor, expensive land, limited credit, and bureaucratic issues. These constraints could limit India's ability to fully capitalize on the shifting trade dynamics. Still, global sentiment is tilting in India's favor. Foreign investors have poured $25 billion into Indian markets this year, outpacing others. Many foreign firms are eyeing India as a de-risking destination, well-positioned to gain from the US-China standoff. If it can address its internal bottlenecks, India may indeed turn this moment of global tension into a long-term manufacturing breakthrough.